Welcome to Small Group Health Insurance Trends and Challenges. My name is Kelly Edmiston. I'm the Policy Research Manager at the Center for Insurance Policy and Research at the NAIC. CIPR is, we're the kind of the core research. There's research that goes on all over the NAIC, but we're the core research area for the NAIC. And you've probably seen some of my colleagues doing presentations throughout the Insurance Summit. So today we're going to talk about small group health insurance, and I'm speaking with my colleague Anchi Chen, I'll just let her introduce herself. And again, I want to thank you all for coming. There's not going to be anything earth-shattering. I mean, we're trying to, small group health insurance is complex. And so a lot of this will just be explaining what small firms do and can do in order to insure their employees. So first of all, when we say small group health insurance, we mean basically health insurance provided to workers by small firms. And there's all sorts of definitions of small businesses. Like the Small Business Administration, for the federal programs, it's less than 500 people. I mean, I think 498 is a lot of employees, but some don't. But the standard we're going to use is the standard of the ACA, the Affordable Care Act, which is a small business is one that employs less than 50. An employee is, they're talking about full-time equivalents where full-time is greater than or equal to 30 hours. There are 4 states where the small business threshold is 100. I know, let's see if I can, California, Colorado, maybe Vermont is right. And sorry, I forgot the other one, but Colorado, I believe, is going to go back to 50 in 2026. But here, as we go through this presentation, when we're talking about small businesses, we mean firms with less than 50 employees. Under the Affordable Care Act, firms with less than 50 employees or small businesses are not required to provide health insurance. And so there's no penalty if they don't offer health insurance. However, a lot of small businesses do want to offer health insurance for many different reasons. For example, retaining employees, highly qualified employees. Larger firms are required to pay to provide health insurance, and if they don't, the costs can be quite significant for them. And I won't spend too much time talking about that. So we're going to begin with some status and some trends. I'm going to talk first and then turn it over to Anchi. First of all, if we look at firm size and like how many small firms provide health insurance to their employees, obviously not all of them do. It's a luxury for many. You can see that as you go from past 50, there's a big jump in the percentage of firms that provide health insurance for their employees. It's about less than half for firms with 3 to 9, about 2/3 for those with 25 to 49 employees, and then it jumps up into the 90s for these other firms, perhaps in part at least because of the penalties associated with not getting providing health insurance. That being the case, that is, I could say it's the penalties that might cause that jump. It probably is to some extent. But if you look at 2014 in the blue columns and 2024 in the gray columns, this data is a little less granular than what I had up before. You can see that there's not a big change in the percentage of firms that offer health insurance coverage compared to 2014, which is when the Affordable Care Act, most of the provisions came into play. Again, this hasn't changed much at all over time. You can see there's no big drop or change in slope or anything around the time of the ACA became effective. And you can see that over time in the last 25 years, that actually fewer small firms, that is those with less than 50% or 50 employees, are providing health insurance than was the case before. Not only are you more likely to get health insurance coverage if you work for a larger firm, but also the small firms tend to pay a smaller share of the health insurance premium than do large firms. So in here, the gray area is between 0 and 25% is the employee share. And so you can see at the top, the blue on the far left is it's a I don't know, there's a misprint there, but that's you don't have to pay any. Okay, and so that is the case for some small firms, but the employee as you get to larger and larger firms, which are on the bottom, the employee is required to pay a larger and larger share of the smaller firms is required to pay a larger and larger share. Over a quarter are required to pay more than 50% of the insurance premium. So what are the drivers of these trends? Clearly, the trends we see where fewer small firms are providing health insurance coverage for their employees than was the case in the past. Well, it's mostly cost driven. And here you can see the average health insurance premium for a family from the last 25 years. And so it's grown from about $5,000 in 1999 to over $25,000 in 2024. I mean, there's inflation, but at least until 2021, inflation wasn't that high over that period. But it's not largely inflation. It's largely medical cost inflation specifically. This chart here shows the national healthcare expenditures, and that's what's driving the premium costs, is the cost of healthcare. And you can see that the blue line is private health insurance, and then the green and gray lines are Medicare and Medicaid. But there's been a huge increase in healthcare expenditure over the last few decades. But most of that actually has come because of the increase in the cost of medical care, not from increases in utilization. So if we look at the cost of medical care, the green is the employee portion, the blue line is the employer portion, and the gray line kind of between them is the total. And the black line there is the CPI, the Consumer Price Index. So that's the overall prices, how have overall prices grown over time. You can see that the cost of medical consumption has increased dramatically relative to consumer prices overall. And if I would have mapped out, and I wish I would have, just utilization, that is, if I would have adjusted the expenditure for the prices of medical costs, medical goods, it would have been relatively flat. Utilization has been relatively flat. The increase in expenditures come almost entirely from medical cost inflation. So what are the options available to small groups? Well, one option is a fully insured plan. And for firms that have less than 50 employees, just over 60% have fully insured plans. And so with the fully insured plan, it's traditional health insurance. The employer pays a fixed premium to the payer, and an employee will pay part of that. And then the payer assumes all financial and risk for the claims and the uncertainty regarding the claims. So it's still the dominant form, like I said, 60% for insurance for small businesses, but that's changing as more small businesses are going towards self-funded and level-funded plans, which I'll talk about next. Moderately larger firms, that's the bottom bar, about half, or a little more than half, use traditional health insurance. Self-funded plans are just what they sound like. The employer assumes the financial risk of employee health care. If most large firms, and you can see here with firms with 1,000 or more, or 5,000 or more employees, a large majority of them use self-funded plans. If your employer has a self-funded plan, it might not be recognizable to you as an individual because they'll typically use a health insurance company, for example, to administer the program. So you might still have a Cigna card or something like that, but it's the employer who is bearing all the risk of the financial risks associated with claims. There's some advantages. Obviously, at the lower levels, smaller businesses, there could potentially be a huge risk if you're self-funded, right? If you have 4 people who work for you, and one of them gets a serious illness that costs millions of dollars, then there you are. Because of that, and this is true for larger firms too. Almost all firms, except the very largest ones, have a stop loss. And so if the expenses get over a certain amount, then they have insurer pays the overage. So it's in a way, it's almost like reinsurance. The level at which that limit is set is called the attachment point. So the larger insurers will pay the premium, or will cover the risk, but they'll pay a premium to a stop loss insurer. Why would they self-fund? There's several reasons for that. One is that they can, avoid state regulatory requirements because they're regulated under ERISA. Why would they want to do that? The arguments are that there could be more consistency if you had facilities across states. You wouldn't be subject to state premium taxes and some limitations on profit margins and some other things like that. But that's typically why they do it. There's also some potential administrative cost savings. The next, similar to self-funded plans and more common among smaller firms, are level funded plans. And these are a partially self-funded arrangement. The employer pays a fixed premium to cover the employee claims plus stop loss insurance. So they're bearing the risk. Again, they have stop loss insurance, and the NAIC had a model law for how much the stop loss insurance ought to be at a minimum, which was about $20,000. Most states, except for maybe 10, have a provision that says you have to have this minimal level of stop loss, and almost all of them are over the 20,000 limit. So with the self-funded, they're assuming some of the risk, but they're limiting their exposure for high costs. It's very similar to being fully insured in some ways, because you're paying the level amount for the claims for your employees, and then if the actual expenditure ends up coming below, then you can recoup some of that cost, but you have your stop loss insurance, which protects you from the financial risks. And under the ACA, the ACA had big plans for small group health insurance for small businesses, and the program was SHOP, the Small Business Health Options program, it never really took off. It was established under the ACA to provide like exchanges, just like the individual health insurance plans, and it was established to provide the small firms with kind of streamlined access to ACA compliant plans, that is the qualified health plans that provide the 10 minimum requirements, and eligibility for the small business health tax credit. And the requirements were that you had to have at least one enrollee who wasn't the owner, or otherwise it would be individual insurance, right? It would have to be offered to all full-time employees, and at least 70% of those eligible must enroll. Formerly, there were SHOP platforms on the federal exchange and on state exchanges. And SHOP, though, as originally envisioned, as being kind of very similar to the individual exchange, is pretty much gone. It never took off. You still will see in some states something that looks like a SHOP exchange, but what it is a way to facilitate direct to carrier enrollment. So in almost all states, even though there could be some facilitation in some states, the purchase of SHOP certified insurance is directly with carriers, or enrollment directly with carriers, or assisted by a broker. But the SHOP link, the small business tax credit, remains available. And I'm going to turn this over to Angie. I think you were to finish us up here. And then we'll take some questions.
Thanks, Kelly. Hello, everyone. My name is Anqi Chen. I'm a postdoc researcher in the Center for Insurance Policy and Research at the NAIC and a health economist by training. So I'll take it from where my colleague Kelly left off. And so we've looked at the bigger forces reshaping the small group market. Now let's take a closer look at how these trends are playing out for employees on a practical level. Specifically, I want to discuss how changes in benefit design are shaping what coverage actually looks like for people in small group plans day to day. So one clear example is a sharp rise in deductibles over time. For single coverage, what we see is that the percentage of covered workers at small firms with a general deductible of $2,000 or more has jumped from 16% in 2009 to 50% in 2024. At large firms, that figure went from just 3% to 26%. So small group employees today are not only more likely to pay a greater share of their premium, as we saw in a previous slide, but they're also much more likely to face higher deductibles and greater cost sharing overall compared to employees at large firms. So all these trends reflect the increasing financial pressure on small employers to manage rising healthcare costs. For many, that's what makes some alternative arrangements like individual coverage, health reimbursement arrangements, or ICHRA look increasingly attractive. Because those arrangements allow employers to set a defined budget for health benefits, while also giving employees greater choice and flexibility in selecting coverage that actually fits their individual needs. Looking ahead, there are two policy issues that stand out. First, we have the enhanced advanced premium tax credits that are set to expire after 2025 unless Congress acts to extend them. These enhanced subsidies have made individual market coverage dramatically more affordable for millions of Americans, including employees who might otherwise rely on small group plans. So if these subsidies revert to their previous less generous levels, we could see major shifts in coverage patterns and affordability with potential downstream effects for small employers and their workforce. Second, there is a lot of uncertainty around the regulation of short-term limited duration insurance plans. In 2024, new federal rules were issued to sharply limit the duration of those plans. But what we see is that as of August 2025, enforcement of these limits has been paused following ongoing litigation and an executive order that directed federal agencies to review regulations to identify those that may impose undue burden on small employers or significant costs upon private parties that are not outweighed by public benefits. So what this means is that for now, short-term limited duration insurance plans may continue to be available in some states as an alternative for healthy individuals seeking lower premiums, even though these plans lack ACA consumer protections and can further fragment the risk pools. So both of these issues can actually add real uncertainty for small group market stability over the next year or two. As market continues to evolve and new challenges emerge, small employers are increasingly turning to different approaches to meet their coverage needs. Two options that are attracting growing interest, especially among employers looking for more flexibility or affordability outside the traditional group insurance market, are individual coverage health reimbursement arrangements, or ICHRA, and qualified small employer health reimbursement arrangements, or QSERA. ICHRAs allow employers to provide a set dollar amount which employees can use to purchase their own individual health insurance, either on or off the exchange, or to reimburse qualified medical expenses, all with tax-advantaged dollars. QSERAs work very similarly, but they are limited to employers with fewer than 50 FTEs and have annual contribution caps set by the IRS. What we see that the adoption of these arrangements is rising very quickly. The number of small employers offering either ICHRAs or QSERAs grew by about 17% from 2024 to 2025, which is a very significant jump. The trend is even stronger among large employers, but it's still small businesses that make up the biggest share of ICHRA adoption. It's also worth noting that among employers that offered these arrangements in 2025, 17% transitioned from traditional group insurance, while the rest, 83%, had not previously offered any health coverage at all. Another point that's worth noting is how these arrangements affect the risk pool for individual marketplace plans. 2025 data show that employees aged 18 to 44 remain the largest share of marketplace enrollment via ICHRAs or QSERAs. This group is historically lower risk and lower cost, so their entrance into the individual market helped stabilize the risk pools, which in turn can support more consistent premiums and also better overall affordability. States are also starting to see these arrangements as a scalable way to support small businesses. For example, in 2023, Indiana established a dedicated employer tax credit for ICHRA and QSERA adoption with up to $10 million in credits annually for small businesses. Georgia, Ohio, and Texas have proposed similar legislation using tiered or contribution-based incentives for small employers. Another alternative some small employers consider is health sharing ministries. These are typically faith-based nonprofit organizations that facilitate the sharing of medical costs among its members. So members of these ministries contribute monthly shares that function very similarly to premiums, but these ministries are not regulated as insurance at the state or federal level. In fact, as of 2018, 30 states have state laws that explicitly exempt health sharing ministries from state insurance codes. We've seen health sharing ministries grow dramatically over the past decade. Estimates suggest that enrollment increased from fewer than 200,000 before 2010 to at least 1.7 million by 2023. The biggest growth happened in the years right after the introduction of ACA. More recently, though, growth has slowed as ACA marketplace subsidies have improved, and also the individual mandate penalty has been eliminated. So despite the growth we saw, there are some important caveats. First, these ministries often exclude pre-existing conditions and certain types of care, and there is no guarantee of payment for medical expenses. One service these ministries commonly restrict is maternity care, with many ministries requiring a waiting period before members become eligible for reimbursement. In fact, among the 10 largest health sharing ministries, at least 8 have this type of restriction. Second, some health sharing ministries may also require members to make an additional payment at the end of the year if regular contributions didn't cover all shared expenses. So while some small employers may suggest these as options for staff who can't access traditional coverage, it's crucial to recognize the risks, especially for employees with significant or ongoing medical needs. The last alternative option we'll cover today is association health plans, or AHPs. These arrangements allow small employers join through a bona fide association to purchase large group coverage as a single entity. So to qualify as an AHP, the association must have business or organizational purposes and functions unrelated to employee benefits. The idea behind AHPs is to give small businesses access to more affordable and flexible coverage options similar to what large employers enjoy. The 2018 AHP rule relaxed the eligibility criteria by also allowing sole proprietors and businesses in the same state or metropolitan areas to form AHPs. However, this rule was largely invalidated by a 2019 court decision in New York versus United States Department of Labor and was formally rescinded in 2024. Following the 2018 AHP rule, there was a temporary rapid increase in AHP enrollment, especially in states that took a more passive approach. Here are some trends we saw in the new AHPs that were formed shortly after the 2018 rule took effect. So first, we saw that 43% of the new AHPs allowed sole proprietors to join, while 54% of new AHPs limited membership to employers with 2 to 50 employees. Among the newly formed AHPs, 38% of fully insured plans and 75% of self-funded plans allowed for sole proprietors. We also saw that 71% of new AHPs were regional associations, which were often chambers of commerce based. Lastly, the Georgia Chamber of Commerce estimated that the total statewide pool for its insurance would eventually reach 800,000 enrollees. However, these arrangements also come with their own set of challenges. First, while some AHPs claim to follow ACA rules, there have been noticeable gaps in benefit coverage and compliance. For example, health insurance plans offered through AHPs in the large group markets are not required to cover the essential health benefits. There is also the risk of claim skimming, which means healthier groups join AHPs, leaving higher costs in the exchanges. Looking ahead, there are two new legislative proposals on the table that could potentially significantly impact state authority to regulate AHPs and the small group market more broadly. The first proposal, the Association Health Plans Act, according to the NAIC, would maintain state authority to regulate AHPs as multiple employer welfare arrangements, while the second proposal, the Self-Insurance Protection Act, could limit states' valid authority over insurance, encourage risk selection, and put workers at risk. The NAIC has also raised concerns if the latter proposal passes. More small businesses could use level-funded arrangements to exploit ERISA's preemption of state insurance laws, offer lower costs to some by eliminating important consumer protections, which ultimately would raise costs for those who remain in the traditional small group insurance market. That wraps up our presentation on the key issues and recent developments in the small group health insurance market. We will now open the floor for questions. Thank you very much for your attention.
Questions, comments? We've got a good bit of time left, so be happy to argue a point or hear a comment or answer a question. Anyone? Was anyone wondering what the difference between a self-funded and a level-funded plan was? See, that's a question you might want to ask. The difference is, I bring this up because the self-funded plan, the risk really is with the employer. I mean, they're insured, they're self-insured, they're insuring themselves. They bear all the responsibility for all the claims, all the uncertainty that goes along with what the claims are going to be, and to the extent that they don't have stop-loss insurance. Most of them do, at least some price point. The difference with the level-funded plan is they're paying what looks kind of like a premium, right? They're making a level, hence level-funded, level payment every month for the coverage of their employees plus stop loss plus administrative costs. Should costs go above that, they bear some of the risk of that, but they have stop loss insurance also. And so for regulatory purposes, the level funded plans are treated like fully insured plans because it's one of these things where if it looks like a duck and it quacks like a duck, then it's probably a dog. So one of the issues that we're dealing with, of course, is you can see across all these different types of, whether it's association plans or level funded plans or whatever it is, it's attempts to kind of maybe get around some regulations, whether that be ACA or state insurance regulations and so on and so forth. That seems to be the big story around a lot of these new small group health insurance plans.
I don't think we necessarily regulate self-funded. I'm sorry. This is Martin, Swanson, Nebraska. I don't necessarily think we've regulated level-funded plans, though.
None of the level.
No,
even
had significant
if the stop loss insurance portion is essentially traditional insurance, right?
That part is yes, but we don't. We don't consider that, at least Nebraska, health insurance. That's a P&C product.
Okay.
Level funded plans are regulated as self-insured plans.
Yeah. Okay. All right. Thanks. Oh,
Yep.
thanks, Martin. Oh,
Yep. And then one more thing, the House bill does not include funding to extend the subsidies. That just came out today.
oh, okay. Wow. Okay. Thank you for that news, Martin.
Kelly?
The Senate had killed that already, I guess, last week. But I just want to drive home a point, Kelly, something you said for regulators in the room when it comes to self-funded plans. You mentioned, your example was the card says Cigna. And, you know, the average consumer, if you're talking to them, they're calling into your office, they're asking who's the insurance with, they're going to say Cigna or Blue Cross Blue Shield, or not really understanding that difference. But I know in our consumer assistance area, it's just a constant, right? That they believe they're with a plan who happens to just be the administrator of the plan, but it is a self-funded plan. So just to drive home that extra point.
Good. Thank you.
Kelly?
Yes.
JP, on the self-funded, the level-funded plans, so states, as was highlighted, can deal with the ERISA piece. They set the stop-loss limits, and they can decide basically whether or not the insurer is allowed to have those stop-loss limits that attaches. There's an aggregate and a specific attachment point, and usually they focus on the aggregate. But that is really the only piece that they do. There have been some rules around lower numbers. There have been rules sort of outside of that to say you're not allowed to offer it to certain size groups. That certainly has been a piece of it. We've seen some of those, and some of those are, you know, not necessarily in statute. They're a little bit more desk drawer style rules, which is a term I think most regulators hate, but that's fine. But that's sort of where it lands. And then the other piece is, I think for some of those plans, the poorly designed level funded plans not only put the consumers at risk from the standpoint of coverage, a small employer, but sometimes they don't have run in and run out insurance if they're moving, which is sort of continuing, because once that checkbook is gone, the employer is then responsible for those claims if there's no reinsurance attached. So if they move and they haven't purchased run out insurance, a claim that occurred at 12/31 and is submitted 1/1 may not be paid if they don't have run out insurance.
All right. Thanks, GP. Anybody else?
But just to follow up on JP's point, and I think kind of the point that you were trying to make when you were talking about the stop loss piece, states can regulate stop loss in all sorts of different ways. JP's right that right now it's pretty much just through the attachment point and caps and other issues. But we've looked at that in Colorado, and I think it will be something that we continue to look at moving forward if that market continues to grow, because it is, and it's an expanding market that there's all sorts of problems in.
Yeah. Thanks. Okay, well, we'll give you 11 minutes and 51 seconds back to your day. So thank you all for attending and for your questions and comments.